Guys, Pete Fishman, MozartData.com. They've got big customers like Modern Treasury, call it almost 100 customers paying on average $1,800 a month. They're pushing a $2 million run rate today in a really good position. They closed a $15 million Series A last year at pushing, call it somewhere around $100 million valuation. And they're being pretty scrappy about it. They didn't go hire 100 people. They're 25 folks full time today, taking a disciplined approach to growth. We'll see what happens next. Hey folks, my guest today is Pete Fishman. He's a CEO and co-founder of MozartData. He's over a decade of running data and data adjacent teams at startups in a variety of industries, including gaming, social, HR and benefits, real estate, and many others. When he realized he was building the same thing at every company, he said, man, I got to build a modern data stack that anybody can use. And that's why he launched MozartData.com. Pete, you ready to take us to the top?
Ready to do it.
All right. Who's using you these days? Is there any customer you can talk about in a use case?
Sure. I would say that obviously we love highlighting our big customers. So we've got a few unicorns that are using us. I love obviously giving shout outs to a company like Modern Treasury, who's been one of our longest supporters.
How do they use you? Everybody knows Modern Treasury. That's a good example.
Yeah, a company like Modern Treasury uses us as their core data infrastructure. So they have an incredible data science team, data analysts, even folks that sort of work as data engineers. But they sort of focus on organizing, structuring their data so they could, build insights and reports and sort of monitor those for the company rather than sort of spend most of their time, doing the data sort of plumbing and data infra work that's really become rote and commonplace for many of these companies.
And when we spoke back in December of 2021, you told me your pricing model was based off compute and number of rows. Is that still the case today, or have you changed your pricing model?
We have not changed our pricing model. We are still planning on not reinventing the wheel on that front. There's many great data companies out there, and we want to copy essentially the norms that they've put into the industry. So we want to price in a very standard and transparent way. But one big difference that those companies don't do versus us is that we bundle those things. So many of those companies charge on compute, or charge on rows. We charge on effectively the bundle of compute and rows.
They get you on both. It's a pain in the butt because you'll need a bunch of one and not a lot of the other, but you got to pay for both, sort of thing, right?
That's right. So we have a singular currency, so you can be sort of fungible between those two, right? So some companies, they have just giant, often like these are B2C companies that are tracking many things, have a bunch of rows, but maybe they're not doing as heavy or complex joins on top of them. Or sometimes you have B2B companies that have very valuable rows. So each row represents a lot of money or potential revenue, but then maybe they're bringing in very few to their warehouse, but maybe they're doing a lot of analysis of each and every customer.
Very cool. And talk to me about growth and usage. You said customers on average were paying about $1,800 a month 2 years ago. Where are you at today?
Actually, that number is pretty flat for two reasons. One, our largest customers have expanded. So, we've actually set new records last month and the previous month for our sort of biggest usage-based customers that are paying us north of six figures. But we've also brought on board a lot of sort of more early stage companies, and we've sort of introduced more new pricing that is much more early stage friendly. So the net of those two sort of balance out on our ACV.
Okay. Fair. Do you have your first $1 million account yet?
We don't have a seven-figure account, but we are. You'll be one of the first to know when that happens. But there are a lot of companies that do spend a lot of on data infrastructure. Obviously, many companies that spend seven figures. We obviously target the SMBs, and you would be surprised at how quickly consumption goes up once they start seeing value in data.
Oh, 100%. Okay, so about flat there. You launched this in 2020. You told me when you came on, I think it was last year, that I think this is right. You guys did a 15 million Series A, right? Last year?
That's correct. Yes.
Talk to me about that. Was that before? Was the market already crashing at that point, or did you get that in right before things started going a little haywire?
I like to think of it as like Indiana Jones, where like it just sneaks in as like the door is like sort of coming down. I don't think we raised at the start of 2022, so not the world's best time, but in hindsight, basically yes, the world's effectively best time.
Yeah.
I would say that obviously we raised a great round at a great time, which means that we have a long runway, so we are trying to still have a pretty forward-looking perspective. Obviously, not that we see an end to our runway, but I think we also do want to be responsible. This is not my first rodeo, and I've seen companies that have kind of used their runway poorly. So we want to be pretty intentional about what we're trying to do.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time, you can see what it changed over the past 88 days, and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your FounderPath dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of FounderPath, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here, and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview.
And was that Series A pretty standard? Most folks are selling, call it 10, 15% of the company in their Series A's back then. Were you sort of in that same range?
Yeah, exactly. So,
okay. So you're pushing then a 6-figure value. Sorry, a 9-figure valuation than over 100 million.
That would be obviously if it were 15%, 15 million on 15% would be 100 million. So yeah, I think obviously valuations and fundraising and quantity of capital available were obviously very different in 2021.
But I guess not to put you on the spot, but the reason I asked that question is there's a lot of folks that did great rounds last year at really high multiples. I think you were at like 2 or 3 million in run rate when you did that, which was like a 40 or 50x multiple, right? Something like that.
No, we were actually just south of 1 million. So actually, it was like if you take that number, it ends up being obviously a bigger multiple.
Yeah, that's interesting. So I guess the reason I bring that up is obviously every startup, you also sold 7% to YC back in the day for 150K. You're part of that program. You've got to manage, obviously, the storyline you tell your team on their option value. And so if they see the market going crazy, but you were bragging a year ago about how you got a really great valuation, minimized dilution, how do you now reverse that narrative and tell the updated storyline, which is, guys, your options are still above water. Don't worry.
Well, I mean, we don't think of basically the private valuations or the sort of current state of the market as the key indicator for kind of the success of the company. At the end of the day, this company will be, especially for the employees, the common holders, which include me, there's very few outcomes where the company ends up being worth exactly the amount that we raised for. The company, the modal outcome of the company, the mean and the median is that ultimately it goes to zero. But there are many outcomes where the company is wildly successful. So we don't really we don't really harp on the likely outcome for many companies in the seed and Series A stage. We think about kind of what the opportunity is, and we race pretty hard to that. And in terms of options being underwater, obviously I've worked at many companies. Some the options
The
were
drill. That's
successful.
why I asked.
Yeah, some of the options were successful and some they weren't. A couple of things we did do. So we did do a reset 409A. So it is the case that firms that are doing 409A valuations have been very different about those valuations the back half of 2022 than they were in 2021. So
you're still seeing though about 30% discounts to the last round, or are you seeing something different?
In terms of the 409As?
Yeah, the 409As all last year were coming in 30%, about 30% of what we were seeing the valuations at.
I mean, to be totally honest, damn, now I'm doing the math in my head. It was steeper than that. So it was almost a 50% discount. So,
okay.
I would say that.
Well, no, not steeper. Sorry. What I was saying is what I was seeing was 70% discounts where the valuation was 30%.
Okay, so that was not what I was seeing in our 409A. But resetting that for employees was actually important. So it gives them greater confidence that they are going to be above water, and that there's a lot of value in essentially holding their common shares and their belief that our company can get to a really great place with our runway.
Pete, what's the team size today? How many folks?
We are 25 folks. So
that's great. So you've grown without adding a lot of, because I think last we spoke you were at 20 or 21 people. So you haven't gone on some crazy hiring spree.
Sorry, we're about 5 people bigger than when we last talked, 5 or 6 people bigger than last talk. So you're talking about 20 or 30%. And to that end, obviously that sort of corresponded to a little, honestly, a little shrink in what was our model. So our model was to double our people and more than triple our revenue. And I think that we've been a lot more focused on doing everything efficiently, and we sort of got that cue really early. I think before a lot of companies really that became the thing that everybody started doing.
Yeah. The LinkedIn post that went viral.
Yeah.
Very cool. Talk to me about customers today. So obviously you mentioned you're adding at the top of the funnel, lower ARPU, but you're also expanding with big ones. How many total customers are you serving today?
No, we're below 100 customers. I was really hoping to get there for this podcast. And when you multiply that by our ACV, which I mentioned was between 20 and 25K, so we're pushing up against hitting 2 million. And I would say that our goal is to really expand on the low end. So we still see really great NDR in our cohorts.
What's good? Like above 130, 140%?
Yeah. So the answer is yes. So some of our initial cohorts were just ridiculous. So over $2.
Wow.
But once we see those companies maturing and starting to really add all of their data sources, we're still seeing, well above, $1.25 and, into the $1.50.
Yeah. So 125, 150% NDR is what that means, right?
Yeah, exactly.
Yeah, very, very cool. All right.
I just benchmarked it against the dollar.
No, I think that's great. I think that's actually way easier to talk about it against a dollar. I'm a dollar, not a percent guy. Cool. I guess any other things that you think are sort of is non-common advice, but is true because you've done this so much, advice you'd give other entrepreneurs?
Well, so I would separate out a couple of things. So you mentioned one, just trying to motivate the team with equity, but being extremely generous given kind of the likelihoods of potentially being out of the money. So you have this tension of, are the teams valuing equity at a time of high inflation and, kind of the world is collapsing, but what you get are the true believers in your company. So it's a little bit counterintuitive. The ones that are finding kind of that difficult to find motivation in it, probably aren't quite the right fits for your team. So we offer extremely generous equity packages to, join the company, which is also why we've had maybe a little bit smaller of a growth, right? So we've been focused on giving out, and as a result, we also had a larger equity option pool because we did anticipate maybe.
What's large? Most standard ones are like 5 to 7% attached to the Series A round. Did you do something bigger than that in terms of ESOP?
Yeah, we did do a little bit bigger than that. So, okay. And with that sort of corresponds to the philosophy, and I think it matches what I think of as your opportunity, which is, now is the classic time to join startups. These are when the heroic returns actually happen. We think that we have the runway to make something special happen. So it's kind of getting in at the right time, I think gives us like really a unique opportunity, as opposed to one where there was so many competitors that are able to sort of join us along the way. So you mentioned that one from the start. The other one that I think is, one that I talk about, we sell to SMBs, and typically like hot SMBs, right? Like, so companies that are growing, that are getting data, that are growing with that, that segment is going to be a lot more dollar constrained, right? And so you have this sort of counterbalance that I'm seeing, which is, on the one hand, we sell a product that's supposed to substitute out a much, 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 much more expensive product, data engineers. A data engineer might cost 100x what Mozart costs. So on the one hand, we have sort of the sort of tailwind of, we're a sort of a cheaper product than the data engineer. So that's an incredible tailwind in this tightening of money. On the other hand, the companies that we sell to have had a huge money crunch. Maybe if you raised at the right time, great, but many companies that are sort of really tight on budgets and are, worried about their next fundraise, we find that challenge of selling into that group.
Interesting. Well, it'll certainly be a very interesting next 12 months. It sounds like you have plenty of runway to get there. But on that note, Pete, let's wrap up here with the famous 5. Number 1, favorite book.
I mentioned this the first time, but I'm going to go back to it. It's Moneyball. So Moneyball is the inspiration for finding unique things in data, and I've sort of based a lot of my personal career around it. I started my career in sports analytics and now have made a career in tech analytics.
Number 2, is there a CEO you're following or studying?
Yeah, I think I'm going to go with another cop-out, and I mentioned this last time.
No Stuart Butterfield.
I know I'm going with Derek Steer, so I'm wearing a
there you
hoodie.
go.
So, Mode is a company that
you were an early investor, weren't you? The first investor.
David Sachs and I were the first 2 investors in Mode, the company. They spun out of Yammer, which was a team that I ran. And now, ironically, they're a great partner of ours, and that it pairs nicely with Mozart. But the thing that I respect most is that they have forged a really great path of selling to data analysts, and they think about the analyst so deeply. And then on top of it, they've started to be able to solve problems that you get to as you mature, as you move upstream. So we really do want to follow exactly in their path, and I'm gonna take a cue from that whole founding team, but Derek in particular, about sort of being a thought leader and that driving kind of that growth into larger and larger organizations.
And if you guys want to learn from Derek, he is one of our keynotes at SaaS Open coming up in 14 days in New York City, saasopen.com. Come learn. Great story. I don't know if that's public. We won't chat about that yet. Number 3, what's your favorite online tool for building the business?
So favorite online tool, well, we have to certainly shout out some of our customers. So like, I obviously am a big fan of Rippling. So, I'm not, believe it or not, an HR leader. You did mention off the top that I work in HR tech, but having somebody to sort of steal that work from me and making sure that our employees get paid is first and foremost right.
Number 4, how many hours of sleep do you get every night?
I'm a light sleeper. I think they call it like a dolphin sleeper. So I do about 5 to 6 hours a night. And I am drinking coffee now, but I also drink coffee maybe 2 days a week. So I'm sort of freakishly able to get by with like 5 or 6 hours of sleep.
That's great. I think you've had 2 birthdays since we last spoke. Are you 43 now?
I am still 42.
42. Okay.
Getting it. Dan and I started the company effectively in our 40s. So late to the entrepreneur game, though we did start a hot sauce company together 10 years prior, but late to the entrepreneur game, but still going strong, still got the energy of a 24-year-old, even if I'm 42.
That's great. And
they answered everything.
Married, any kids?
Getting married.
You mentioned
in June, having, so we'll see if I can keep my energy through the marriage, and then whatever comes next.
That's awesome. And Pete, last question: something you wish you knew when you were 20?
I think the things that I'm actually going to my I actually just signed up to go to my 25th high school reunion. So I was 18. And the things that I really wish I knew. And I think it's, I actually just had this moment of thinking about it. I like to say that it kind of all works out. The things that I cared so much about, I remembered caring about, whether or not I was the captain of my, high school math team, or whether I, was, achieving some sort of like, not meaningless accolade, but that kind of has translated into, that desire for that, and that push for that was exactly, I think the things that sort of perpetuated me in different stages of professional growth. But it's also, I wish I had cared a little bit less about it. And I also often feel silly about mentioning like high school accolades for obvious reasons 25 years later. So I would say that it kind of all works out as the thing that I most, wish I knew or could wrap my head around.
Guys, Pete Fishman, MozartData.com. They've got big customers like Modern Treasury, call it almost 100 customers paying on average $1,800 a month. They're pushing a $2 million run rate today, in a really good position. They closed a $15 million Series A last year at pushing, call it somewhere around $100 million valuation. And they're being pretty scrappy about it. They didn't go hire 100 people. They're 25 folks full-time today, taking a disciplined approach to growth. We'll see what happens next. Pete, thanks for taking us to the top.
Thanks, Nathan.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers. They try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company, or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them, and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.